Before we jump in today's video, I just want to remind everybody that I'm not a financial advisor. So this video is for educational and entertainment purposes only and should not be taken as financial, investment, or trading advice. All investments involve risk, and you should do your own research or consult with a licensed financial professional before making any investment decisions. Just remember, past performance is not indicative of future results. Hey everybody, it's Paul here on my channel, Better Call Paul, and today I have a special guest. You all already know him. It's Jordan Collier from his channel, Covered Call ETF Investing. Jordan, welcome to my channel.
Thank you, Paul. By the way, I often get Jordan Collier. It's actually Collier, but that's
Oh,
okay.
I spelled, or I pronounced it
On
wrong.
my wedding day, our pastor, we had told him where he said he's like, is it Jordan? Is it called the Colliers? And we're like, it's
Nope.
Collier. And then up on the stage, he's like Coulier, just messing with us.
That's awesome. Okay, I apologize for that, but
All
so
good.
I've been watching Jordan for a long time, and I was really lucky to meet him last year at the Blossom event. You know, a little bit starstruck. Got to meet a YouTuber I've been following. And Jordan, I've noticed with your journey, when I first started watching you, you were quite conservative, and a lot of times you were buying ETFs, kind of like BMAX, maybe HDIV. And I was always sitting back going, man, Jordan, if you would just buy some ENCL or just buy some of this, you could double your income and so on and so forth. And then all of a sudden, you kind of made that switch, right? Now, I know there's a reason why. So maybe just explain to people what happened and what made you kind of like add a little bit of firepower to your portfolio.
Yeah, I mean, sure. I mean, some of those, like you had mentioned ENCL there. I've actually owned ENCL on a couple of occasions over the years, and part of it is just kind of you're trying to figure out your portfolio, trying to figure out all these different accounts, and it's not like, say, for newer investors hearing this, that you're gonna just have this bulletproof plan at the very start. It's an evolution. It's
Hmm.
it's you're climbing a mountain. So certain funds I would put in one account just because that's all I had for the longest time was a TFSA. I had so much room in my TFSA because I had just never invested before. I'm like one of the youngest people alive in Canada that can take advantage of the full pull for the TFSA because I was 19 in 2009 when that came out. So
Nice.
it was a nice surprise to me when I first started investing in 2020 that I had all this room to work with inside of my TFSA. But it really wasn't until last year that I capped my TFSA. I had capped my other registered account, my wife's spousal RSP, and now I was looking at what should I put in a non-registered account. So I wanted to go with Canadian funds, mainly because I wanted to diversify away from the AI concentration and tech concentration in the US. I still want to participate in that. I think for a lot of investors, to I would, in my opinion, to participate in greater capital growth, even with income, it's still, for me, better to see the majority of my money in US listed stuff. So Canadian ETFs that invest in US companies, but I wanted one third, just one third to invest in Canada that would be away from all of that stuff. So that was kind of one of the main reasons. So I looked at funds like ENCL. I looked at some other sector funds that focused on utilities and banking because those are our home bias sectors. Now, US stuff, I like to invest in index stuff and proxy index stuff. But here in Canada, it's a bit of a different landscape. I'm not as interested in investing in index type stuff. I like to actually hold the sectors because they are just so much more prominent here in Canada. So that's what I decided to go for was, Bank by Evolve, Utes by
Evolve.
Evolve,
Yep.
and ENCL by Global X, and Etchy by 9 Point. That was my, essentially four horsemen that I'm using here for my Canadian allocation. Plus, you get better tax stuff, or I should say, you get better tax treatment with Canadian companies inside of your portfolio. So, for those who are a little bit more familiar with tax factors, ETF distributions are broken up into a bunch of tax buckets: ROC, eligible dividends, capital gains. Those are probably the three best. Then the next bunch are not, which is like other income, foreign income. Those get taxed at your marginal tax rate. So if you're invested in any kind of foreign stuff, you have potential for that exposure. Now, typically it's small, but I didn't want any of that exposure. Wanted the favorable tax treatment. Typically, with the sector funds, you get some higher yields as well, and especially now since I'm on paternity leave, I wanted higher yielding things in my portfolio. Not by a lot. We're talking mid-teens. So it's a little bit more than my US exposure, the yields that you would typically see with US exposure. But we're talking 15%, 16%, 17%, somewhere in that range. So I wanted to go for that. And so, anyways, that's why I decided to jack up the yield in my portfolio. In one regard, was also because like I just need the income to pay for expenses during this paternity leave that I'm on for the next 15 months.
Jordan, it sounds like you set up your portfolio for success, especially with the 12 to 16 months, almost like bull market or bull run the Canadian economy's been on. So
Yeah.
smart, good for you there. Did you, by any chance, make the mistake I made and invest in things that held Bitcoin?
No, I've been really consistent on my channel over the years of the things that I don't invest in. I often have said in my videos is that I actually think it's more critical to figure out the things that you don't like versus the things you do like, because I can almost guarantee you the things you don't like, you have bigger opinions on, and they're much more acute. So once you figure that kind of stuff out, then it becomes so much less stressful to figure out what you do like. So for me, so Bitcoin, it's not that I hate Bitcoin, it's just not a productive asset. It really does rely, I mean, the people that are invested in Bitcoin, I know they're going to say so much more. I'll get to that, but it is not something that can produce something else. Okay, it relies on basically someone being more excited than you to buy it just to push that price higher up, right? So I take the Warren Buffett approach. I want the farm. I want a farm that produces something. However, I've also made this distinction over the years is that if we go on a Bitcoin standard, let's just do it. Let's rip the band-aid off. Let's go ahead and just do it, because the problem it's trying to solve is currency debasement. That's a massive problem. We need scarcity. We need some sort of money scarcity, and Bitcoin, right? If it can't be multiplied or created in some other facet, then that could look like a really solid solution. So it's a bit twofold as far as investing. Not interested. As far as a use case, yeah, I'm for it. Let's just do it. But anyway, politics get in the way of that.
Yeah.
So anyway, Bitcoin, gold I don't invest in. It's kind of the same principle. It's not a productive asset. Bonds, junk, don't care about those. I don't want to invest in anything related to government. They don't know how to spend our money. It doesn't matter what level. So no confidence there. I actually recently had like some political party come to my door like a couple of days ago. Like they talked to the wrong person, because I talk in terms of like my concern. It revolves around capital, and everything else from there will filter into place. And I ask them, what's everyone around the neighborhood talking about? Crime and healthcare. And I'm just like, man, we need to like get a belief, like we need to treat our entrepreneurs really well. That's what we need to do, and everything else will filter into place.
Mhm.
Anyway, so bonds, nope. Single stocks, I got into ETFs to make my life easy. Single stocks, or stocks in general, so single stock ETFs or just stocks in general, I look at those like I just they're complicated. To me, if I'm going to get into a single stock of any kind, even in an ETF format, I got to understand what that business is all about, quarterly reports, forward-looking guidance. I got to understand all the various ratios and all that. And I did that initially, and when I first got invested, it was fun. I'd go into work every morning, and I had this kind of primordial, archaic way of valuing companies, so it was a lot of fun. But after a while, I realized, this takes up a lot of time. I need to adjust my strategy to make things easier. ETFs offered a way to make things a bit easier, because honestly, you need to know, once you go through a couple of market cycles, you kind of know which sectors are to play. versus individual companies that could go bankrupt. So
Yeah.
those are my four don'ts, the four things I don't touch, and everything else is all game, and
Yeah.
it makes things easier.
Yeah, well, Jordan, it sounds like you avoided some of the mistakes that I made and I know other investors made, especially as we yield chase a little bit, right? Because Bitcoin offered higher yields, strategy offered higher yields, and all the single stock ETFs, so on and so forth. But you know what happened to a lot of them, and a lot of people like myself are now down in those positions, trying to get out of them. But anyways,
Yeah.
with the new launch of so many ETFs, just recently I've decided, and I think maybe you have as well, to get into the commodities as another sector in Canada. Uh, how do you feel about it's Global X's CMCL?
Yeah, CMCL, which is their 25% leverage version, or up to an approximate 25% leverage. Nobody ever uses 25% leverage. They always use a little bit less. They never do it because they'll be out of compliance
Right.
if the value of the fund goes, if they get shocked and goes down, the ratio of leverage to the NAV will be higher. So they're always using less. But anyways, up to 25% leverage, CMCC, the unlevered version. And anyway, so yeah, I decided to get into that. I'm going to work towards about a 5% allocation across my whole portfolio. That allows me to hold on to things like oil and gas, which, we just talked about ENCL. I really want to hold ENCL, but there's so many. What I'm finding is with ENCL, 25% leverage on oil and gas, is that there's so many, like every couple of years or even every year, there's some sort of shock in the market that just sends oil up. And the thing is, I've been through this cycle with oil before, and I know it's just going to go down. It'll go down eventually. It is very sensitive. So with something like ENCL, it is, to me, it is much better to create a strategy around capturing capital with it, sell it off, let it come back down. It will. Oil doesn't, it doesn't grow up
It's
and to the right.
it's
It,
cyclical, right? It's
it
cyclical. I'm with you. I sold my oily, I sold my ENCL. I'll wait till it drops back down to whatever, 17, 18, even
exactly.
$19 will be better than
Yeah,
now it's at like 23.
that's right. I'm in, honestly, and through other funds that I own, I get exposure through pipelines and oil and gas. So CMCL, it gives me a way of holding on to something like oil and gas. It has about a 30% allocation to oil and gas. So that's fine. I'm just gonna, that'll be my long-term hold, 5%. And I get exposure to that and lithium and whatever, gold miners, silver miners, copper miners,
Yeah.
stuff like that. So that's okay. I don't want it to be a massive position, just a little slice that gives me exposure to something that maybe I would kind of play for a season and not necessarily hold the long term. So
Yeah.
yeah, and you get an attractive yield in that 14% range.
Yeah. All right,
Really,
Jordan,
really.
I probably have 100 questions that I could ask you about your portfolio construction. But what I really, really want to dive into, and the focus of this video now is going to be, I want to learn more about margin. I started my margin account back in November. I've been very, very, very cautious with it. And I've noticed
Yep.
that on days when the market's crashing, 8 out of my 11 ETFs are in the green. So it's
Yeah.
fantastic. But what I want to know is more about like actually living off of your margin account. Not 100%. I know you don't pay 100% of your bills with your margin account, but even if I could pull $500 a month out of my margin account and just add that to my income, that's what I want to learn how to do. So maybe you can explain the strategy you're using.
Sure. Okay. So let's maybe back it up a little bit.
Yeah.
Especially with margin, because we always got to say this, Paul, anytime we talk about it, is that anytime with borrowed money, it is not for everybody.
Right.
And that works on both sides of the spectrum. Like let's take maybe some other creators that we know really well who definitely don't use margin. Adriano, Perry, Gary Gill, those
Yep.
guys don't use margin. And I'm not in their situation, but I'll go on a whim and say they probably don't need to use it.
Right.
Their expenses are covered, so they can take an approach of, be on the side of not interested, don't need it, and they don't really need to recommend it. It shouldn't. that's probably something they shouldn't recommend, but
Right.
they're probably on that side of things. But then there's the other side of things, which most people are going to find themselves on. So people who are newer investors, people who haven't seen market cycles, people who don't have clarity of mind, don't have a plan, haven't maxed out their registered accounts, those people should definitely not use margin. You want to be right. You want to have seen a few things in the market, build up some calluses and experience, so that, especially if you can't sleep at night, don't use margin. Okay, if
Yeah.
your portfolio is already giving you heartburn and you're not using margin, I can guarantee you, margin will not solve your sleep problem, your
No,
sleep apnea or insomnia, I should say.
you got it.
Uh,
Yeah.
okay, so those are the sides that people were talking about here. Okay, so last year, and for most of my investing days, I didn't have one really strong opinion or of the other. To me, it's all like, there's so much in investing. There are tools out there we can all use, and um, we don't have to have like a strong absolutist dogma towards. Just have an open mind, because you never know what you can learn. But anyway, two events happened last year that I noticed. Wealthsimple started showing in their app how much you could borrow if you got into a margin account. And once I saw that, I knew that's gonna sucker people in right away.
Oh
It
yeah.
will.
Yeah.
It just will, because now all of a sudden it's just frontline center. I can borrow up to whatever fathomable amount you're gonna have. You're gonna find yourself in a day, in a daze, just dreaming about all these extra things you could buy, and extra income and higher yields and all this like kind of stuff, whether you're an income investor or not. So that was one. But at the same time, for me personally, I found out that my wife was pregnant with our fourth child, first daughter.
Oh,
And
congratulations.
so thank you. And so these two things kind of came about at the same time. I wanted to start making more content around margin, just to sort of kind of help people think of it in a more conservative light. And I also started thinking about using margin for myself, because I knew that I wanted to take a full pull of paternity leave once baby was born. So I wanted to take 18 months off. So I wanted to craft a plan around that. So to me, I needed to do two things. I needed to jack up yield internally, but I also needed to take out margin as well. Now I could do two things here. I could borrow a bunch and let the and then basically take the distributions, or I just go into the account and borrow kind of little bits at a time to support myself. And that's technically less money during the time that you take off, but I opted to go for the borrow a bunch of money, like one big lump sum. So what did I do? Well, in 2025, the summer, I was looking at, okay, how much is my forecast? Like, how much money in a year will I make off of distributions? So it was $60,000 at the time. I'm like, okay, you know what I'm going to do? I'm going to pull forward $60,000, put that into conservative style of Canadian sector cover call ETFs, modest leverage, and I'm just going to let that build more income, reinvest it. So I did that for a season. And then once the new year started, I actually just started keeping it as cash to pay down the margin a little bit. And I basically decided, okay, I'll borrow 60. I'm going to not going to go past that threshold. Like, that is my guardrail. It is so ingrained in my head that there have been times I've slightly gone past it, just because you get like a little interest, you get like a little interest thing tagged onto. So it goes like a little bit over by like $100. And I immediately try to figure a way to like pay that down, because to me, I've mentally just seen that as like nothing above 60. That is my hard line. Will not borrow anything past that. So I've borrowed, or I've paid it a little bit down to give myself a little bit of a gap and wiggle room if I need to borrow for living expenses. So anyway, that's what I've done. The margin account has done surprisingly really well. I have 3 funds in there right now, and like I said, I wanted it for tax efficiency, slightly higher yields, diversify away from the U.S. Those are the three big reasons. I did not think that they would perform the way that they have done. I think like now the account is up, like all time return is like in the 80% range. It's just crazy. I did not expect that. and that wasn't the intent or the prediction or whatever you want to call it. But anyway, specifically to your question, how do you live off of this stuff? Well, really, if you're using Wealthsimple to use margin, no matter what happens with that account, if you put money in, as if you've borrowed money, if you put money into it, it automatically pays down the margin.
Mhm.
There is no like separate cash allocation, just pays it down. If you get a distribution, it pays it down.
Right.
So right now, when I get a distribution from my margin account, it pays down the margin. So for investors out there, just as an example, I currently have a balance of $53,000. So it pays it down to $51,000 roughly, but then I extract that $2,000 to live off of. So,
Mm.
in July, it'll pay it down. I'll extract that for my living purposes, and then it's just on repeat. It's just on repeat.
So,
Unless I,
so you have, Jordan, if I got this right, you have $60,000 invested in your margin account.
so I have, I put up about, let's call it $65,000 of my own money.
Oh, you put your
And
own
then
money into the margin account.
so that was initially because I should have started with that.
Yeah.
Initially it was a non-registered account.
Okay. Yeah.
Okay.
Yeah.
I upgraded it because Wealthsimple allows you to upgrade your non registered account into a margin account.
Yeah.
So at that rate, then you can actually borrow money for it. So and that's when I borrowed $60,000. I linked my TFSA to it to
Yeah.
give myself more buying power. So if you don't link your TFSA, you'll get like,
Yeah.
whatever, how much of room. Link it, then you get more buying power. You can't link your TFSA or your RSP naturally, but those two you can pair them up together.
Okay. So you have your original 60,000, you put another 60,000 from the margin. So
Yeah.
what, 125,000? And
Yeah, something like that.
every month it generates 2,000 exactly, or
Yeah,
2,000.
roughly.
Yeah.
Yeah. It's like about 2,000.
And you pull out the whole 2,000. Now,
Well,
what about the interest?
yeah. So for the interest, like I said, I have a little bit of a buffer there between 53 and 60. So it grows ever so slightly. Like the interest kind of chops away into
Yeah.
that buffer, like ever so slightly. Like to me, it's very slight. I have that buffer for a reason for things like that.
Yeah.
So I'm not like I'm not technically paying down the interest, albeit I guess you can say I did when I borrowed 60 and got it down to 53. I guess in that from that angle you can say I have.
Hmm. Yeah. So what I did, Jordan, was I didn't initially. I had deposited only $18 into my margin account,
Oh,
but,
really?
but then
Okay.
I actually pulled the $18 out because it skews your results. If your margin account's made like $1,000 in dividends and it thinks you deposited that $18, it base all of your percentages off of that. Like you've turned the 18 into 1,000 or whatever. So I pulled it out and it fixed the numbers. And now I'm up to about, I think, $32,000 worth of ETFs that I've invested in.
Yep.
And it pays me, say $350 a month. But then
Mhm.
there's also the interest. So what I'm thinking about doing is if I make $500 a month, I pay $100 in interest, technically I should be able to withdraw that $400,
You can.
right?
I mean, that's exactly what I do. I mean, if you have a margin account, not only can you invest in securities, but you can also treat it as a portfolio line of credit. So I'll give people an example because so many people have Wealthsimple. If you have a margin account, Wealthsimple will not let you sign up for a portfolio line of credit under your under the like the spending section on your in the Wealthsimple app.
Hmm.
You'll see something that says you can add a portfolio line of credit, but you can't sign up for it because you have a margin account and you can take money out for basically anything. So that's how that works. But yeah, you can use it for both things if you want to use it to invest or you use it to just take it out and spend it on living expenses. That's what I do,
Yeah.
and it was really maybe maybe in May was the first time that I actually took money out for living expenses. And that was like the first time and it worked just fine. Did the same thing for June. As soon as those dividends came in, they paid down the margin. Then I just took that worth of margin out. So technically, I'm not taking out any. I'm taking out margin is really what's going on here, right? I am technically living off of margin in a sense, but to me, it's just the dividend. The
Yeah.
dividend paid margin, and I'm just taking it out to get it back to that $53,000 mark.
Wow. That's
Yeah.
amazing. I think you were right what you said at the beginning of this. There are people who have multi-million dollar portfolios. They don't really need margin, right?
No,
And then
no.
my opinion, Jordan, and it's only my opinion, if you haven't been investing for at least 5 years, don't
Mm.
even look at margin, right? Because if you haven't lived through some of these swings, you haven't seen your portfolio drop by 20, $30,000 in a week and bounce back. Yeah, it would be really scary to have margin for the first time. So
I'll put you this way, Paul. If you are, let's just say, if you have your phone and your fingers doing this over the buy button, you should not be anywhere near margin
yeah,
whatsoever. Okay.
yeah,
I remember one of the first stocks I owned was like Enbridge, and this was like super early day, like very early days investing, Jordan.
yeah.
And I remember I was like, I was working. I'm a pipe fitter, but I was so stressed out because it went below my my book cost, and I was so just I couldn't even think straight. So it just goes to show, like, I remember what it was like, but I remember like running off to a sea can to like sell Enbridge, and then I felt silly after it. I just felt so silly. I was like, because I had just bought it, owned it for a week, sold it, and
At a
then I
loss.
was like, yeah, I was like, it only went down. I don't know what it was. Maybe I was down $30 overall. I didn't have much invested in it,
Yeah,
but I was just so like, it was messing with me. So investors, you got to get past that phase, and you will see. I had, and I went through. I use that as an example because that happened to me. My first ETF, I was like $300. Now I move
shaken.
like tens of thousands of dollars around. I don't even flinch anymore. So
Yeah,
you got to get past those examples there, even to consider, in my opinion, your opinion, to can really consider margin.
yeah,
And honestly, and one thing I should mention, Paul, which I haven't, is just like how much margin I'm using. I'm not using, like, people think of margin like for day traders, or think of it for like swing traders, or just using it to invest in trading products. But that's really not my speed. I don't like active strategies like where I'm round trip buying and selling all the stinking time. That sounds like a lot of work. That sounds like a lot of stress. That
yeah,
sounds like I'm going to be losing sleep over. So as far as margin usage, I want to use it in a manner that is very specific. It is so specific. I'm not just buying it just because the market dipped 0.5%. It's like I'm using it to be in this experimental retirement, this paternity leave, and I'm really only using across my whole portfolio. It's like 12%.
right, right.
And then if you take out the RSPs, because RSPs don't give you more buying power, it's not the margin count's not linked to that, then it's more like 17%. 17%. I just try, the way I see it is, try to stay the hell away from a potential margin call as humanly possible. Basically, if I'm using 17%, the market, the world's got to end. And like at that rate, there won't even be a margin call because there won't be a stock market anymore. Like, that's how I think about it. I think
Yeah,
of it like, okay, we got in, like, I'll be more worried about investing in bullets and coffee. You're right. If I get margin,
yeah.
that's how I think about it.
And you're already a very seasoned income investor, and you're just using the margin to continue that income investing. It's not like you said, you're not looking for a penny stock that you're going to put 20 grand into, and if it goes
No.
up, you're going to make 100 grand, but if it goes down, you're going to lose 20 grand, right?
Yeah.
You and I are on the same page. We're not like using margin to try and hit home runs and make a
No.
fortune of money. We're just doing exactly what we've been doing already for years with income investing, and now we're just doing it with a little bit of margin to give us a bit more leverage, I guess.
Yeah, and I think it is probably easier for guys like us to get into the margin, mainly because we have exposure to leverage through internally through all the various ETFs we're invested in, we already have exposure. So we have a level of comfortability, 25% leverage, pretty much attached to, I mean, not every cover call
Almost.
ETF out there, but it
Almost.
feels like almost everything out there.
Yeah.
So using margin was sort of kind of the next, evolution.
Yeah.
And so a lot of the various margin videos that I've done is pretty much anything you've heard in this interview here is pretty much all the same stuff I say. I don't really deviate.
Yeah.
I don't think I deviate at all from any of that. It's just I want to use it in a conservative, passive manner. It's to build income over time, be flexible, so I can take it out when need be, and it gives you more options. But I know there's a lot of hostility, and maybe not even hostility. It's just there's just a lot of creators out there in the finance space that don't use margin, so they naturally default to don't use margin.
Right.
But in a way, you got to use it just to really understand the mechanics on a personal and emotional level, to speak about it in a different way other than just opening a textbook and then kind of just reading for yourself as well. There's also tax benefits with like writing the interest off as well when you use it. So even though there's like, and let's just say Wealthsimple, their current interest rate is something like 4.45%.
Yeah.
Well, it really does depend how you're using the income from the cover call ETF, the distributions, if you're borrowing the money. But that effect, like you could write off, depending on your marginal tax rate, you could actually get that rate technically lower with writing a portion of it off. Now there are rules around that, but you can effectively lower your effective interest rate on what you see from the various brokerages that allow you to borrow money.
Yeah. And keep in mind, everybody, I don't know about Jordan, but I'm not a tax accountant. This is just stuff that Jordan's researched on his own. But if you're going to do it, definitely talk to an accountant, talk to a professional, and figure out what you can and can't do before you go ahead and make your investments. You said you have three holdings. Do you share that on your channel? What you have in your margin account, or?
Yeah, I do. It's I think I said that at the top of the video. I got Utes from Evolve, Bank from Evolve, and Etchy from 9 Point.
Yeah, that's in your margin account.
Yeah, that's in the margin account, and those things they are the for me they are the three strong pillars of the margin account. I don't That's like one part of the portfolio I really honestly don't even look at, because it's just the capital growth has now, like, there's such a strong buffer with each of them. I'm not really worried about like a pullback whatsoever. So yeah, just extract the income from it, and I do the same thing with my TFSA, extract all the income out of there as well. So those are the two main spots I draw income from.
Have you ever sold an ETF in your margin account, or not yet?
Yes, I did. I did a video on it. I accidentally sold ENCL.
Oh, that was in your margin account. I watched
That
your
was,
video. I know you
yeah,
sold it accidentally because you were playing
yeah.
with your
So
kids.
yeah, I was like watching this like thing. I was watching this like marble races on YouTube with my kids, and I'm kind of staring down at my screen. I was trying to put on a stop loss. I was like, I was in the mindset that, okay, I am gonna sell this, but in case it moves higher,
Yeah.
I want to put a little bit just to extract more capital growth out of it. But as it turns out, I don't know. I can't even remember exactly what I did, but I set the wrong thing, and it just sold it off. And I'm like, oh no, that was not supposed to happen.
Yeah.
I still got 23% capital growth out of it,
Yeah. That's
plus the
amazing.
dividends over a 9 month period that I held it. So
Yeah.
I did really well on it, and it I don't know, it was like I can't even remember exactly, let's just call it 40,000 or something. It paid the margin down to like basically nothing, but then what do? I reload
Yeah.
to the amount that I had in there before. I actually took the profits. It was about $8,000 in profits, and I just took 7,000 and punted that into my TFSA because I hadn't
Nice.
put anything in there. So
Nice.
that's one. At least it gives you options.
Yeah. Yeah. I sold oily in my margin account because I wanted to see like just I need to see things how they actually work, right? I want to see, okay, if I sell oily and I'm up $500, I'm going to realize that gain. Like, are they going to put that in an account for me, or what happens to the money? But it just goes to paying down your margin,
Yeah,
right?
yeah,
Yeah,
that's it.
yeah,
That's kind of what you just got to realize is like you sell it, you're using more margin. Like anything that you use is just margin. If you have invested, if you have used margin in your margin account, all the money that you use is going to be margin, no
yeah,
matter how much you dump in, unless you pay it off,
yeah.
right? Or the distributions that come in. It's all going to be margin.
Yeah. So I did that. I sold the NCL. And then one day I did something, Jordan, just for fun. I picked up $1,500 worth of PLTE because it had
Yep.
dropped down to like $15 and something cents. I sold it 3 days later for 1956. So I made 23% in 3 days.
Oh,
Yeah.
that is a nice that's I mean investors should obviously realize that's the exception. It's just not the rule with that kind of
No,
stuff.
that's
Um,
being risk. That's being risky. But again, that's where you have to know your own profile, right? Like risk profile. If PLT had gone lower, I would have bought more, right? And it
right.
just happened to shoot up in a few days, and I sold it just for fun, just to get out of that position and not have that extra risk in my margin account. Anyways, Jordan, I know you got a wife and 4 kids, so I don't want to keep you all day, but I appreciate so much you coming on my channel, and I hope we can do it again somewhere down the road. I'll probably see you in July. You're going to be at the Blossom event.
I that I'm still trying
Still
to
on the
figure it out
fence? Yeah,
because of the PII event. I don't know if I can do Toronto twice in one summer. I also
yeah,
got stuff with the family going on. We're going to all kinds of places locally to stay. So
yeah. But you're
I
going
don't
to
know
the
yet.
PII event.
I'm definitely going to the PII event. Yep,
Okay, so worst case scenario, I'll see you in August.
that's right.
All right. All right, everybody. Thanks for watching, and bye for now.